You've worked hard to build a dream retirement. Now it's time to put that plan into action. This is Retire ATL with Aaron Vincent and Matt Decker. The team at Vincent Financial wants to help you build, protect, and grow income to get you to and through retirement. Now, Retire ATL with Aaron Vincent and Matt Decker.
This is the Retire ATL podcast, all powered by the Vincent Financial Group. You can get more when you visit retireatlradio.com. Thanks for subscribing. Thanks for downloading. Now, let's get to the show.
Gentlemen, let's get right to it because everybody's talking about the market. Yes, the economy, we're seeing it every day, but the market continues to set records. And if you watch enough financial TV, you'll notice a pattern. There's always a forecast and then a strategy built around said forecast. I want you to hear this clip from wealth manager Eddie Gabor. They asked him on Fox Business what he's expecting from the market over the next few months.
You should expect a summer correction, but I would be buying those hand over fist because the biggest thing I've seen here is people have missed this rally. It's been really hated. They continue to ask how much higher can it go? And this is a real earnings story. These aren't just companies that are fly by night. And if we get a gift of another summer dip, we will buy hand over fist because I think by the time we get to the end of the year, markets are going to be much higher and we're going to surprise to the upside on growth economically as well as earnings projections.
Is it me or does he sound like Theo Vaughn?
Yeah, he kind of does.
He's moonlighting
Like
as a wealth manager as well.
A quant Theo Vaughn.
Yeah.
You should expect a summer correction, but I would be buying
Hey,
those
man, have
hand
y'all
over
tried the
fist
latest
because
pill? All right, so listen, timing the market, that can be dangerous. Buying the dip could be a good opportunity. And when you hear him talking about buying the dip, because there's no telling what's going to happen next, Aaron Vincent, how do you respond?
Markets it's a fascinating conversation. Everyone's got an opinion about the timing of the markets, and I think it's relevant. I think these conversations, like if you want to really get in the weeds about how you're going to be investing in the short term, next few months, for example, yeah, I mean, there's nothing wrong with saying there may be a dip coming, let's get ready to buy. But by and large, like we are long-term planners. Like I'm not a stockbroker, Matt's not a stockbroker. I have no desire to be a short-term trader of short-term market trends. And so what I don't want to tell our listeners is that there's a good time to invest and a bad time to invest. And make sure you get it right on the good time or else. Like investing is not a one-dimensional thing. Either the market's down and you should buy now, or the market's up and it's too expensive and you shouldn't buy. That is way too one-dimensional. There are so many different layers of investments to be involved in, and there are so many different options, whether markets are up or down, that I think taking one step back from just the summer and is there going to be a dip to buy, I think there are lots of ways to apply your investment dollars regardless of conditions. I'll give you a quick example. Like one of the portfolios that we work with a lot that's just been on a tear this year is our stock dividend portfolio. If you want to know more about kind of what I'm talking about from our different portfolios, I would certainly encourage you to call. We are not a sort of a mutual fund buy and hold for the next 20 years, kind of simple cookie cutter, plain vanilla. That's not kind of our MO. I would love to tell you more about what we do, and we might be able to get into it all on the radio, but 770-741-0120 to get more on that. But what I was getting at is our stock dividend portfolio. So there are ways that we manage and build portfolios that have a section of that based on stocks that pay dividends. Not all just growth stocks. What's the S&P up today? What's the Dow up today? But what dividend do they pay? And there are lots of really, really good stocks that are going to pay a 7, 8, 9% annual dividend. Plus, there's usually some growth as well. And so that's just a quick example. It's by no means a prescription to everyone, but it's just a quick example of maybe how we can take sound bits like this or ideas of you've got to buy now because the dip or what might happen in the next few months and think there's some of your investment dollars could be applied that way. Sure, find opportunities and jump when you can. But then there should be a major part of your portfolio or your plan that is kind of slow and steady wins the race. Some returns better than no return sitting on the sidelines over a long period of time.
I think it's interesting how he said that he's seeing a lot of people that have missed the rally.
Mm-hmm.
Well, how do you miss the rally? Like, how do you actually miss the rally?
You're just on the sidelines, not doing anything.
You're on the sidelines. And I think more than anything, that's where people get kind of lost, kind of in no man's land. Because the only way that you miss the rally, and really the market rally has been, it's not just like the last year or two. I mean, we're talking about like the last 15,
right,
almost 20 years. There's been just a huge rally in the market with some periods of volatility in there. But man, if you've missed the rally, that means you're sitting on the sidelines. And he also made the comment, how much higher can it go? And we hear that all the time, actually. People come into the office all the time and they say, like, well, how much higher can it go? Like, I don't know. And people,
a lot is the answer.
People have been saying that every single year for the last 20 years. How much higher can it go? Mm-hmm. So I think we just got to frame the conversation the right way. And instead of talking about, like, do you buy the dip, or should we expect a summer lull, or whatever. Should you buy and hold, or should you actively manage your accounts and go in there and make a bunch of trades and try and time it? For me, and I'll speak for Aaron too, because I know he sees it on a daily basis, the people that get hurt are the ones that just simply try to time the market. Because how difficult is it to get back into the market if you're currently sitting on the sidelines? Is hard. Mm-hmm. It's really hard because you've already missed the last 20 years or however long you've been on the sidelines. You've already missed the run-up. And you don't want to be the person that I got in when it started to go the other way. But that's kind of the position that you put yourself in if you play the timing the market game. You have to get it right. And it makes it really difficult. And it becomes a overly emotional decision because you don't want to be the sucker that buys in at the top.
Yeah.
And so that, to me, I think if you're worried about retirement, or maybe you're not worried about it, but if you're in the retirement window and you're struggling with these feelings about, like, what do I do with the market? How much higher can it go? I've missed the rally. When do I get in? When do I get out? To me, that tells me that you actually need to just change your mindset. And instead of trying to worry about timing the market, you need what Aaron talks about, which is a durable portfolio, where it doesn't matter if the market's going up or down or sideways. You have a plan in place where you can succeed in all those different market conditions, and you don't have to be the person that has to get it right every time. And the second you don't get it right, it's like, oh, my plan broke. It was great until it wasn't. It was going great until I made that wrong move, and now I've locked in a loss. I'm sitting on the sidelines, and I can't get back in because I'm gripped with fear.
And if you're a market timer, that will always be your story. You just don't know when.
Exactly.
You may have a longer run than your neighbor.
Exactly.
But that will always be your story.
And you may say, well, that won't happen to me. And it's like, well, it hasn't happened to you yet.
Because of the last 15 plus years of a run-up.
Because in order for it to never happen to you, it means you have to guess right every single time. And you may say, well, no, I'll just write out my losses. My gut tells me that the person that's saying that isn't retired yet, using their portfolio for their income. Because the second that you actually retire and that portfolio becomes your only source of income outside Social Security, now, it was easy to sit through
now
it.
Write it out.
That's right. Write it out now. Write it out now, because actually you still have bills to pay.
Right.
You still have a lifestyle to support. And so you actually don't have the luxury of just writing it out once you actually retire. These are conversations that we have all the time. We find that most people need help with these conversations. It's hard to think through all this. It's like eating a giant elephant. Our job is to make it simple, make it easy, one step at a time, one bite at a time. If you'd like to engage us for that conversation, we'd love to chat with you. 770-741-0120, 770-741-0120. You can also go to retireatlradio.com.
Yeah, Matt mentioned the durable portfolio. So the idea with that, this is something that is sort of the backbone of our investing philosophy. And that is that I'll say this to people sometimes on purpose to get some raised eyebrows and some like, well, what the heck? And that is, look, I'm not really too concerned about getting you really big, exciting returns. People are kind of like, why did I come here? And then I'll say, because if you're chasing that, you will always have some level of disappointment and pain. If we can build you a portfolio that is appropriate for you, meaning that it has the proper amount of you getting compensated for the risk that you're taking. Whatever risk you're comfortable with, we got to make sure that you're getting the returns that are appropriate for that. That's a whole other conversation. But if we can build that, then you will stay in. When the heat gets turned up, you'll be okay. You won't jump in, jump out. It's durable. And so what that means is that when there are opportunities, if this guy, Mr. Gabor, is right, and there's a big dip to buy, if you're already poised with a portfolio that's there and ready and nimble and ready to go, we can take advantage of those things. And guess what you will get? those big, sexy, exciting returns, but we can't start with that. And so one of the things that we talk about with our clients all the time is the idea of having some dry powder. So our portfolios typically are built based on the idea of polarity. You've got growth money, and it should be growth money, and it should be focused on that. It should stay in its lane. It should play to its strengths. It should be growth money. Then there's also, a category or a bucket of money that's lower risk. It's preserved from too much market volatility. It anchors the portfolio so that your growth money can stay your growth money, et cetera. Well, the beauty of that is you've got two pockets to pull from. Maybe you're retired, and maybe all of a sudden the markets do drop out. You still need your income. Well, now we've got a pocket to pull from, this less risky money that's not down like your growth money is. And that lets your growth money kind of recoup, let the dust settle, let it rebound and return. And then now we can draw from that when we need to for your retirement. Or let's say that the markets, kind of in a certain period of time are cooperating like they are right now. They're going well. It's so high, it's new records, et cetera. Well, now we've got this money. And if your portfolio is designed right for you and it's durable, we should have a conversation about should we use some of this money as a dry powder for opportunities. If there's a dip coming, guess what? You've got a pocket to pull from that we can use to take advantage of things like a random dip. And so this type of portfolio management, this sort of philosophy around not only building but managing a portfolio in and through retirement is so much more efficient than waiting back and saying, well, when my gut feeling aligns with the circumstances, or when I feel comfortable, or when some random wealth manager on the news says now's the time to buy the dip, then I'll do it. I think that's a dangerous game to play because, as Matt mentioned earlier, you would have missed out on triple-digit returns over the last several years, and there's no worse scenario than lazy money sitting around while that's happening.
So, Aaron, I'm a listener, and I'm hearing you talk about this polarized portfolio, growth money, and low risk money. And I call up the number 770-741-0120, and I say, Aaron, that sounds great, but I've already got it. What do you say to that?
I would say that's fantastic. Explain to me what you have. Like you already have a polarized portfolio.
Yeah, I've got my technology stocks.
Yeah.
And then I've got my blue chip dividend, lower risk paying stocks with, some bonds in there. I've already got it.
So in that portfolio, listener, Matt, what would you consider to be the less risky, kind of safer stuff?
Well, like my blue chip dividend paying stocks and my bond kind of allocations. And I have some lower risk ETFs.
Got it. Well, hey, first of all, kudos to you is what I would say, because you're doing something.
That's why I called.
Yeah.
I wanted the kudos. Pat me on the back, Aaron.
You're doing something, and something is always better than nothing. But what I would say is I would kind of push back on the idea of your safe money, because here's the reality. Warren Buffett's got 2 rules of money. If you heard these or not before, but one of those rules is never lose money. The second rule is always adhere to rule number 1.
Well, I never lose money because I don't sell.
Right. However, when you begin to take income from your portfolio, well, let me ask you this, listener Matt.
Yeah.
Are you retired yet?
No, but I will in the next 2 or 3 years.
Okay, perfect.
I'm a pro.
Yeah. You sound like it. And I'm glad you called.
You should hire me to actually trade your portfolio.
This conversation just turned into a job interview.
That's right. What I would encourage you to do is to take your portfolio and use the tools that you use as a pro to stress test it and find out, just apply like a 2008 scenario on your portfolio. And I would just love to know, I think you would love to know, what those dividend paying stocks and those bonds would have done in like 2008 or 9 or like 2022, and call back when you tell me how safe those actually were. Give me a call back, same number.
So you don't think I actually have real low risk investments?
Right. The fact is you do not have. If those are the 2 categories of less risky money that you're referring to, that's not a durable portfolio. I'm not saying you shouldn't have those, but there should be another category of money for sure.
And this is what we find all the time. Mm-hmm. People listen to us on the radio and they hear us talk about a durable portfolio and a growth money over here and low risk money over here. And most people say, I've already got that. I've got that. And then they come into the office and we're like, well, we'd love to see it. Show us anyway. We'll pat you on the back if you've done a great job.
Yeah.
And they come into the office and they have no polarity at all. None. They've got 85% of their money in equities. And they're like, well, no, but some of those are lower risk equities. It's like, no, that's not what we're talking about. That's not how it works. Like, you have a 35-year-old growth portfolio and you're 61 retiring in 2 years. And that's the reality. That's where you are. Now, if that's what you want, Great. Maybe you've got a 6-figure pension plus Social Security, and you don't need this as your income engine.
Yeah, you got no debt, no mortgage, and a pension.
Great.
Sure.
Huge pension, big Social Security. You got more guaranteed money than you would ever spend, and you've given yourself the ability to have the portfolio of a 35-year-old. Great. Right. Most people aren't in that situation.
Right. And in our role playing just now, I was overdoing this some, but I actually meant it. Like, we're not going to just criticize you. I'm not going to call you an idiot and say, that's not safe money, you fool. What are you talking about? Let me prove to you that you're wrong.
Your portfolio is a piece of trash, and let me show you why.
I think it should be celebrated that you're doing something. Look, if you are within the window of, if you want to retire in 7 years or less, and you've done the bulk of your saving, like if that's where you're at, then you calling someone, you engaging with a professional, I hope it's us, but someone to just say, let's talk about my portfolio. What are your thoughts about it? Should I hire a professional? Should I hire you? What are you going to do for me? Show me the value that you're going to. Kudos to you for doing that, whether your portfolio is awesome or it's terrible. I want to celebrate that because that is the trait. We say this all the time. That's the trait of success. The trait of success isn't you've already made it, you're already wealthy, and you've already done everything in your portfolio is perfect. That's not the trait of success. The trait of success is I am willing to learn and take action to improve the things I learn about. And people who do that, like throughout their lives and particularly in their portfolio management, are the ones who are on top. They're the ones who are content. They're the ones who have a plan. They're the ones who know what they'll do when the stuff hits the fan. My favorite quote in regards to these kind of things is by the financial guru himself, face tattoos and all, Mike Tyson. He says, everyone's got a plan until you get punched in the face. You may have a perfect portfolio right this second. You might. And then tomorrow the punch comes. I don't know what that punch is going to be. It could be a health issue. It could be a market issue. It could be a economic, kind of a political issue. It could be a pandemic issue. It could be anything. It could come out of nowhere, a haymaker from nowhere. And all of a sudden your portfolio is limping along and you're one of the statistics that lost 40% in 2 weeks because you thought you were in a lower risk portfolio and you weren't.
Mm-hmm. Yeah, just to piggyback off of that, Aaron, I love to ask people, and you should ask yourself this question. I'm going to ask everybody listening. If there was a problem brewing in your retirement plan, your retirement portfolio, the way you were invested, if there was a problem in there that you couldn't see, how soon would you want to know that it was there? Now. Yesterday. As soon as possible. And unfortunately, a lot of people, and like my family is guilty of this, a lot of people avoid going to the doctor because they don't want to know what the problem is. Mark's raising his hand. He's like me.
Guy.
My grandpa was that way.
Most guys.
Very much so. Yeah. I'm not going to go to the doctor because I feel okay, and if there's a problem, I don't even want to know.
Yep.
Like, I don't even want to open that can of worms. Mm-hmm. And it's interesting to me that when we talk about money, we talk about retirement. That mentality can kind of carry over for some people. It's like, I don't even want to look. I don't even want to know. I just want to put my head down and hopefully it'll be enough. And I would just say, man, if there was a problem that was fixable, if there were moves that you could make today that could completely eliminate this potential, future time bomb going off, why in the world would you not take the steps today to try to get your house in order?
Right. And make no mistake, what we're not talking about is, hey, you've got to overhaul your portfolio. Big returns and exciting growth out the window. Sorry, those days are done if you want to talk to us. Now you've got to kind of sit that in the back seat and kind of slow and steady and boring and here we go. That's not what we're talking about at all. What we're saying is there's an appropriate level of risk for the income portfolio that you're going to need one day, whether that day is today or it's in 5 years. And our aim, one of our many aims, is to actually beat the benchmarks. So you've heard the benchmarks would be S&P 500, the Dow, the NASDAQ. It's a lot of different ways to compare portfolios. But what one of our aims are for our clients is to beat the benchmarks with less risk. And if you can compress the volatility but still get that level of returns and kind of accompany that with a polarized portfolio where you have some less risk money that you can draw from when your equities are down, if you can just do those things, you're set up very well if you've saved just adequately, in your life. And so that's our main objective. Our main objective is to say, look, these news clips, whether it's about buying the dip in some kind of random summer projection that some guy has, or it's anything that might happen. There's all this turmoil. We're at war one day in the Middle East, next day we're not. There's a truce signed, but no one knows what the terms of the truce are. And, who knows? And that's going to affect markets.
Yeah.
And so, sure, let's be ready for that. Like, we should be ready to take advantage of opportunities that arise, but you can't build your entire portfolio and your plan and your idea of success or failure on whether or not you timed things right. That is the definition of sadness when it comes to a retirement portfolio.
So if you're in the window of retirement, 7 years or less, or maybe you're already retired, but it's early on in your retirement, and these are discussions that you haven't had yet, I would encourage you to call the office, 770-741-0120. That's again, 770-741-0120. Or you can go to retireatlradio.com. We run through all of these different questions and all of these different situations that we've talked about today. We do it at no cost and no obligation. And if you like us, you'll hire us. If you don't like us, you won't. Either way, we will part friends.
Insurance products are offered through the Insurance Business Advanced Planning Group. Vincent Financial Group is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Advanced Planning Group are not subject to investment advisor requirements. Advanced Planning Group and IPW are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be constructed as advice designed to meet the particular needs of an individual situation. Vincent Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained by sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Vincent Financial Group. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. This podcast is a paid placement.